Welcome this afternoon to this week's halftime talk. We're delighted to be joined on this occasion by Dr. Dawood Nassif, the chairman of BAPCO, a longtime friend of Gulf Intelligence. Thank you, Dr. Dawood, for joining us.
It's a pleasure, and it's always a pleasure to talk to you.
Dr. Dawood, it's been 6-7 months since we last had the chance to catch up. Clearly, the world has changed dramatically in that period of time, and as well as our industry has been quite impacted. But I would say within our industry, the oil and gas industry, the energy industry, none really more so than one might think than refineries. I'm wondering, how has the last 6 months been for you and for your sector, and what do you take away from it going forward?
It's no secret, it's been a challenging period for everybody. But through challenges, we see opportunities as well. The period has suffered low oil demand, high inventories, narrow crude differentials, fundamentally resulting in poor refining margins. So if you're a refining industry, it's been a challenging period. This coupled with many other things, new capacity builds east of Suez, the bunker fuel new specs by the IMO, transport restrictions in many parts of the world. But these issues we've had to face years ago, and in many times when cycles, since we started our refining in Bahrain in 1936. We've been through global economic recessions, geopolitical tensions, mounting environmental pressures, peak oil predictions, all of this. And all of this we rode the wave, and we came out for a new beginning, so to speak. And we're doing the same now. We will continue to optimize our costs, which is fundamental to moving forward, no question about it. But this is a time where we're also utilizing to look to the future, and we are looking to the future. As you're aware, we're currently in our biggest investment in our history. And this is continuing. We're about now close to 60% through execution of this mega project in the refinery. And we're also looking into other investments to complement this one. And you will hear next year announcements of future investments that we are undertaking. So yes, there's been challenges. It's been difficult. Refining margins have been less than satisfactory, but we can see opportunity. We can see light end of the tunnel, and we can see ourselves really capturing opportunities in years to come.
Dr. Dawood, did we discover over the last 6 months that the world has too many not fit for purpose refineries? We're starting to see some consolidation just announced over the weekend. Shell closing its Convent in Louisiana refinery, one of a few announcements in the last few weeks. Is that one of the takeaways of this COVID crash and perhaps peak oil demand, that indeed we have too many refineries and we're going to have to cut back?
Well, before the COVID-19 came on the scene, we already had a challenging oil market and challenging refining margins. And come COVID-19, that added insult to injury, so to speak, made things a little bit more difficult. We have seen, or we will see, refining closures in North America, in Europe, in Australia, and the Far East. And Shell in Philippines, and a closure down in Australia, and closure.
What would be the common thread between all of their particular ones that they're closing?
A number of these refineries are not fit for today's markets. They're either size-wise they are too small, complexity, they're simple refineries, topping refineries, and don't have the complexity needed to produce the quality of products to go to the future. And they will either require major investments, or the owner will decide to leave this business and leave it to somebody else. Investments are quite challenging for a lot of people. But in global organizations, in the global leaders companies, they might decide this particular refinery doesn't fit into their overall market, and they decide to exit this one, and they cover the product demand from another location. Australia is a prime example where demand will be covered from other locations.
We've seen in the last 6 months that for a lot of that period, the heavier crudes are doing very well, particularly as mobility was basically non-existent. We're starting to see the sweeter crudes come back. How do you see this period vis-a-vis what types of crude are succeeding? What parts of the barrel going forward will be succeeding?
Well, it's a pricing issue. Whatever opportune crude on the market you find that you can process in your process configuration is what you're going to select. And we've seen heavier crude at opportune pricing, which we took advantage of. At some time we decided, no, we stay with our basic crude diet, which is Arab Light, combined with the local Bahrain crude. So it's an opportunity to look at other crudes to take advantage of various pricing. And when you talk about the barrel, for us, the future is clear. Our barrel is focused on diesel and jet fuel, naphtha to be converted into higher value petrochemicals. And we don't want to be in the fuel oil market. With the current investment, we're down to about 6%. And we expect with the next wave of investment, which we'll announce next year, our target is zero fuel oil. We're out of this business.
By next year?
No, we will announce the next project to follow BMP next year to take us to the final phase of destruction of fuel oil. And to us and to many,
what kind of time frame do you think?
I expect by 2025 we're out of fuel oil altogether. That's our current target, and because it's very simple mathematics. Every barrel of fuel oil that leaves the gates of a refinery is at a loss. It's already below crude. I've personally, in my nearly 40-year career, I've not seen fuel oil above crude oil. And with the more stringent regulations as we go forward coming in from the IMO, I don't expect fuel oil to have a future that for us to convince us to stay in it. Hence,
although there has been some examples in the last few months of jet fuel price below crude.
Sure, and which we've never seen before. It's only this week we're just starting to see jet fuel surfacing slightly above crude. It's been suffering, but no surprise, you and I are not traveling. The flying public is not there. Airlines are suffering until the two products which are mostly under pressure are jet fuel and gasoline. People aren't driving as much, people are not flying as much. And that's the reality of the pandemic and what it's created to us. Until we see the vaccines coming in and the public have the extra confidence to start flying again, we probably won't see a return of the aviation industry for another 2.5 years to what we call a normal level that we've seen in 2019. Which means jet fuel will continue to be under pressure for this period, but it's going to come back.
Is that not an incentive for you to reconsider your strategy?
Oh, absolutely not. We're going to make jet fuel to start delivery on 2023, which we believe we're going to be smack on with the recovery. And no, we will not. Gasoline is going to continue to be under pressure, not because of the pandemic alone, because of the changing fuel forecast. And we expect the inroads of electric vehicles to increase. And that will have an impact on gasoline on 2030 and beyond.
So, Doctor, perhaps you could just remind us, the audience, of your expansion program and the profile of the barrel that you're looking at.
Our expansion program is fundamentally to shift the barrel upwards into the high-value white distillates. And our two main products are diesel and jet fuel. It will destroy fuel oil, and we will leave just about 6% of our overall fuel oil left for us. And the next project, which we will announce in 2021 will take care of the balance of the fuel oil. Also, in the next project, which is complementary, will take care of naphtha, and naphtha will be upgraded into petrochemicals. Hence, we will make
And
petrochemicals.
capacities?
Sorry?
But the capacities that you're operating on now and what you will be with your expansion programs?
The capacity is one of the issues that we're aiming for, which is to take us from the current 267,000 barrels per day to 380,000 barrels per day, which we believe is the size of the refinery that is required in today's world. And so size is one thing, but there are three fundamental drives for this large investment. Of course, number one is yield improvement, profitability. Number two is energy conservation. And number three is total environmental compliance with the most stringent world standards. So these are and we're gonna, fundamentally, it's a hydrogen addition investment, which you're gonna see a resid hydrocracker, another distillate hydrocracker, more hydrotreating. This is the main drive behind the investment.
And when we look at this period moving forward, we've seen the China economies and the Asian economies in general seem to navigate this challenging period better than the Western economies. I'm wondering what your outlook is for demand and demand location versus and how the COVID will continue to influence that.
Well, COVID hasn't had an influence everywhere, but China seems to have weathered the storm. China is certainly on the recovery side, and you can see the economy expanded by 4.9% year on year in third quarter. And there's growth of industrial activity in China. So the post-downturn pattern sees the Chinese government is likely to run a massive economic stimulus in that economy. And as the world,
refineries seem to be operating at very high level throughput.
Absolutely. China is the world #1 importer of oil, and demand for oil will play a key role in the oil market recovery. So China is pivotal in those activity, and they're moving forward. And I think the rest of the world will follow with a certain lag time, but China is the leader in this.
And do you see that market as the destination for your new product mix into Asia?
Only partly, because Asia is certainly a major destination for our products, together with South Africa and Southern Europe. But Asia and the subcontinent are one of our major markets.
We have just obviously the big news of the week, the new president-elect in the United States, Joseph Biden. I'm wondering from the point of view of energy and what impact you think that may have. He has advocated a slightly more green commitment. What's your thoughts on that in terms of the global energy industry and how it may impact?
Well, we'll wait a little bit more to see how when he unveils his economic and energy environmental programs. But he's stated that he's going to rejoin the Paris Accord, and the U.S. will be at the forefront of energy and environmental compliance. And I think fracking and shale oil and shale gas will come under pressure. And but overall, we believe he's going to have a balanced approach, and I'm sure he's got a team who's going to look into this objectively and do what's right for everybody.
But it could be a help. I mean, from the point of view of the Middle East oil producers, it could be positive in the context that if he curtails or puts greater regulatory obligations onto the U.S. oil production, let's say, flaring of gas in shale production, which under Trump seems to be fairly unregulated. Those sorts of things might contribute to keeping the U.S. production a little bit curtailed in its recovery.
Well, I'm smiling, and you can only tell why. Yes.
Yes. It sort of leads to my next sort of theme is that we're in a very distorted supply-demand balance over the last, obviously, 6 months. It's in April. Classically, we saw a 20 million barrel a day destruction of demand. We're going to see, on average, by most analysis on the year, 10 million barrels a day down on demand. So the recovery back to supply-demand balance depends on a serious control on supply. We've seen OPEC perform that task pretty well, but they're facing another big decision now in January to increase production by 2 million barrels a day. I'm wondering what your own thoughts on that is, and generally on supply-demand balance in 21.
I believe OPEC will maintain the current production cuts, to be honest with you. And they will watch the demand on the product side, fundamentally jet fuel and gasoline, which will determine how they react next. But currently, all the reports suggest some deeper cuts. I would think they will just maintain the current cuts and see how the market reacts and demand for products in the next 6 months or so.
And so not proceed with the 2 million barrel a day increase that's planned for January?
I don't see it, and any intelligent look at this will tell you they wouldn't do it.
But nonetheless, the countries, the participating countries, and there's 20 something of them, and a number of them in our region, they're facing very challenging fiscal balance sheets this year. Can they sustain this level of cutbacks, if you like?
Well, the other side would be, if you increase production, you're going to add pressure on the pricing. So what you think you want on one side, you're going to lose on the other side. So it's a market demand, supply, which are going to determine end of the day what happens. Do you want to see price of crude coming down to the 30s level? And you'd rather maintain the pricing and see how the market reacts. And I come back to say it's jet fuel and gasoline which are going to determine the requirements. This is what they demand. People need to fly again, people need to drive more again, and this will determine the extra crude requirements.
And if you take that level of constrained supply and demand in 2021, supply continues to be, let's say OPEC keeps its 6-7 million barrels off the market. The US perhaps remains curtailed because prices are not attractive enough. But the demand side, where does demand go? And how do we're expecting 3 million barrels a day of refining capacity to be added next year. I mean, these numbers just don't add up. How do you see that playing out?
Well, there's going to be additional refining capacity in, but also there's going to be refining capacity out, as we discussed earlier. Plus, although the demand currently for the main products is depressed, it's going to pick up. The population growth is there. The pandemic will be resolved in, if not 6 months, in 12 months. The vaccine will come on the scene. People will fly again. People will drive again. And we're optimistic. We see the market picking up again. And there'll be extra capacity coming in, but also be capacity being removed from the market.
But if you look at that extra refining capacity, which we're seeing a lot of it coming in Asia, and yet we're building here in the Gulf a lot of refining capacity to service the Asian market. How are those two things going to be squared? I mean, are we too late for the Asian market? They're going to service themselves?
No, the market will absorb both, because look at the population growth in Asia. And that will determine the demand, and it's going to come. And the investment is really Middle East and the Far East. And these will complement each other, because the refining capacity the rest of the world is not going to happen. It's going to actually decline. So these two centers, what we call world operating centers, are going to supply the world. And population growth in Asia is there for everybody to see. There's going to be more demand.
And your expectation for the refineries that do get shut in now in this cycle, this downward cycle, will not be of this region in the Middle East, of the Gulf?
Most of the refinery, if not all, in the Gulf region, have the right capacity and have the right complexity in terms of process configuration. These are the refineries that will survive in the challenging markets. Simple topping refineries really have no place in these markets, especially if they're in the 100 to 200,000 barrel capacity or less, with simple process configuration, whether it's a crude vacuum unit and then a simple platformer or a small FCC. These refineries will struggle. The economics just will not support their continue to exist in today's market. And I'm sure the owners, whether they're independent or part of the majors, will make a decision to retire these refineries.
Well, when we look at that point of majors retiring not fit for purpose refineries, we've heard obviously as part of this period also some of the European oil majors pulling further back from oil as part of the critical component of their business model. What's your thoughts on that, and how does that play into this going forward?
Yeah, there is going to be that as well, pulling away from fossil fuels. But today, with all what is being talked about, what is the real alternative? What's the real alternative to flying a plane?
Hydrogen.
Oh, yeah, well, that's a lot of talk. That's a long way to come, okay? And you want hydrogen on your car as well? How many years did car manufacturers study hydrogen in cars, and the day they dropped it? I think over 10 years was studied. Yeah. And frankly, not many people would like to be flying, having a big gas tank in their car. Yeah. That's reality.
Yeah.
Yeah.
Go ahead.
We saw a lot of this, and hydrogen plane is far away as far as we're concerned, and hydrogen car, if not even further away. So these are there, but I don't think they're going to see the light in the foreseeable future.
If you see the European majors pulling back from oil production and from refinery production, that could obviously create more opportunity and more obligation in some respects for the Gulf producers to have to refine their own oil because they can't rely on the majors to do it anymore. And under Biden, we might see actually the American majors be more obliged to move more like the Europeans.
I agree with you. This is the trend that's probably gonna happen, and which will even open more opportunities for Far Eastern and Middle Eastern refiners for the market. And I can see the U.S. policy aligning more or less with the European policy under the Biden administration.
And that obviously would be probably one of the biggest impacts he would have, I would think. Somebody described with me the other day that Biden will save the U.S. Oil industry by making them go into the transition and secure that economic opportunity. Let's just circle back a little bit where we started, and that is on your own future plans. You had signaled your plans for some additional new projects next year. What can you tell us about them?
As I mentioned earlier, our intention is to stay in what we believe is the high value end of the barrel. And the two main products are diesel and jet fuel. One investment will go to destroy what is left of our fuel oil after the resid hydrocracker comes into operation at end 2022. And the other investment will come at the top end of the barrel, where we're going to convert naphtha into petrochemicals. So we'll make petrochemicals, we will make jet fuel and diesel, zero fuel oil, and a small amount of gasoline to service our requirements for the local market.
Do you see that as ultimately the future for the Middle East refineries, that it has to become integrated into petrochemicals, that is the critical piece?
Well, we saw this many years ago, and we see it today. That's why we're going there. The integration of an oil refinery with a petrochemical complex is a plus in, I would say, in all investments of this nature. The cycles of petrochemicals and refined products don't move at the same time, and it'll balance out to keep your business afloat when one of them is at the low end of the business cycle.
Yeah. Go ahead.
Yeah, and we believe in this integration and to go forward.
In terms of just wrapping up and look at the fiscal profile of the region, of course, some countries more than others. Bahrain is in, faces more fiscal challenges than others. Oman, the same. I'm just wondering what your thoughts on is the end of this year now. The fiscal balance sheet of these countries in the region are somewhat under stress. What is the impact of that? The consequence of it? And how do you see that going forward?
Well, we all know that the economies are under pressure, whether it's Bahrain, whether it's Oman, even the richest of the producers are under economic and fiscal pressures. And this will continue probably into next year. But from our side of the business and from our investment outlook, we believe this is the best time to invest. You invest at the low end of the cycle. And we believe we are at the bottom of the cycle. And any investment in our line of business, refining or petrochemicals, takes you 4 to 5 years to bring the project on stream. So we look forward, and our vision is to be prepared in 4 to 5 years' time at the high end of the cycle to take advantage of that. Yes, there are fiscal challenges. Yes, there are economic challenges, and these countries around us have the challenges. But when you show a business case on case-by-case basis for every project, we believe the business case is there, and you should be able to have financing ready for it.
Does it impact, we've seen in recent years, a significant growth in regional demand for refined products, which made the region a big market in itself. I'm wondering, what's your outlook? How is that impacted currently, and what's the outlook for it in 21?
Currently, we know the impact. I mean, as I said earlier, you need to get airlines to fly people to fly. You're going to get people to drive more. We have
3 of the world's biggest airlines within a few hundred miles of each other here.
Sure. But you can see they're coming back. Flights are coming back. More destinations being opened. And I think that currently most of them are about to have half their network operational, which is good. We're nowhere near the 2019 level or before. But you're going to see a gradual improvement and increase through 2021. And towards second half of 2022, I think we should see a recovery of the airline business, and likewise with the lockdowns coming out, people driving a lot more and using their vehicles. So we're optimistic.
Did you see a similar recovery in oil prices over that time period?
Well, once the demand of these products picks up, I think demand for crude will pick up, and we can see the recovery coming under both in terms of volume and in terms of pricing.
I suppose it's a delicate balance as to bringing back higher cost production from other markets or other production centers. Is that delicate balance? I mean, maybe it's a good thing to keep prices in this range for a while.
Sure, but whatever you do in the downstream, midstream, downstream business, you should have the right process configuration, okay, and integrated refining with the petrochemical complex to face the future. If you don't have that process configuration and you've not done the right investment to produce the high value products, and without integration of petrochemicals, you're going to find it challenging to move ahead.
Well, Dr. Dawood, I think that's a good exclamation point in which to finish up our interview halftime talk this week. Thank you very much for joining us, Dr. Dawood Nassif of BAPCO.
My pleasure, and always good to talk to you. And we always look forward optimistically to the future. Thank you.